Welcome to LPC's second quarterly market update for 2025. If this is your first time joining us, we're glad to have you on board. Bit of background to LPC, we are an independent tenant advisory firm with 6 offices across Australia and New Zealand, and we are dedicated to representing occupiers in all aspects of commercial real estate and achieving tenant-friendly outcomes. We've observed that most market commentary tends to reflect the landlord's point of view, and in contrast, today's session is designed specifically for tenants. Our team of experts will provide a high-level review of the Q1 2025 conditions across the office, retail, and industrial sectors throughout ANZ, and as always, this will be through the lens of the tenant. So joining me today are the cream of the crop here at LPC. We have Graham, who will be touching on office, Adrian, all things retail, and Ken in the industrial sector. And I'll be providing some statistical analysis around vacancy and occupancy in each commercial sector. So we'll start off with the office market, then the retail, then industrial, and if we have time at the end, we'll have a Q&A. There's a Q&A function on the webinar, so please feel free to ask questions throughout and we'll get to them at the end. So to get us started, I'll just share a few insights from recent commentary in the AFR and our own market activity across the Australian and New Zealand office, retail and industrial sectors, highlighting some of the trends we're actively helping tenants navigate. So in the office sector, the return to office debate remains front and centre. Some employers are adopting more flexible approaches, such as allowing staff to bring children into the office during the school holidays. As we did here at LPC, we had a few future team members in tow over the Easter break. Others are taking a firmer stance, notably in the UK. Reports such as coming from PwC suggest employees could face dismissal for failing to attend the office at least 3 days a week. On the investment side, we've seen signs that the office asset values may be stabilising, with several property funds reporting their first positive returns in over 2 years. While this is welcome news for landlords, it raises questions about how this may affect tenants' bargaining power, something Graham will explore in more detail. On to retail. One of the major talking points in the retail sector right now is the impact of Trump's tariffs and how they may influence the cost of goods. A key question many of our retail clients are asking is whether these tariffs will have a downstream effect on Australia and what that could mean for pricing and profitability. We are also seeing retailers adapt their offerings to appeal to a broader customer base and in response to the shifting global dynamics, consider growth strategies beyond the US market. These trends are prompting important conversations around how leasing strategies should evolve. Adrian will unpack these developments and explore what they could mean for retail tenants. And then finally, the industrial. So since launching these webinars during the COVID period, attendees will know that positive news in the industrial market has been relatively scarce. Last quarter, we did note a rise in vacancy rates, and that trend now appears to be gaining momentum, with rents forecast to fall by as much as 11% along the East Coast. This will come as welcome relief to many industrial tenants after years of steep rental increases. However, even a 10% drop would only bring rents back to early 2024 levels, highlighting that the market remains complex and difficult for tenants to navigate. Ken will share some insights on what this means going forward. Now we'll start off with the office market snapshot. We'll have the overview of the vacancy data, we'll go through the trends, and then of course we'll look at it through the tenant's perspective. Graham?
Thanks, Ed. Starting off with the office statistics, which many will be aware of, you'll see that the vacancy rates have generally increased across all markets. It's interesting that the Australian CBD office vacancy has increased steadily over the past 5 years, from about 8% in January 2020 to around 13.7% in January 2025. But it has been stabilising sort of over that course of 23 to 24. The non-CBD markets, very similar, increased from 9.2% to about 17.2% over that same period. And again, stabilising in that 17 to 18% band since early 2022. So Sydney vacancy, Brisbane have increased, mainly due to more supply additions. It's remained flat in Melbourne, and I suppose we're forecasting it to remain a bit the same way, whilst Perth and Adelaide and Canberra all experienced decreases in vacancy. our expectations across all those markets are sort of highlighted on that right-hand side. And you'll see we're sort of predicting increases in vacancy in Brisbane, Perth, and across New Zealand, with fairly stable markets in Adelaide, Melbourne, and Sydney. And that's based typically on additional supply coming into the market with flat levels of demand. Q1 is typically a slower period of leasing. That was again the case in 2025. At the moment, there's additional uncertainty around, obviously we've now got the result of the federal election, but over the quarter that was weighing heavily on the market. And also the effects of the global trade tensions. And that's going to probably lead to further caution and indecision from tenants that we're certainly seeing in the market now, going into Q2 and Q3. Flight to quality remains the main trend across the market in all areas, along with a flight to value. The push to improve and modernise the office workplace to encourage more office participation is continuing. The value proposition is critical, with an increased trend for tenants to focus on what the bottom line costs are, reusing existing spaces, and a lot of cases, tenants that are in better quality buildings and suitable fit outs are pursuing that renewal option to significantly, to take advantage of the fact they don't have to spend as much on the fit outs, and they can allocate more of their incentive across to the bottom line rent abatement, affecting their bottom line profits. So it's many tenants are looking at it at the moment going, it's also a great time in the market from a point of view of where the conditions are. Even if their lease expiries aren't that close, it's a great time to actually sit down, talk with your landlord about what can be done earlier, whether it's midterm, 2 or 3 years to go. Going early is becoming more common, and landlords are motivated to talk. So if we go over to New Zealand, a little bit different on their market, but it's an increase in vacancy along or in Auckland, along with Wellington, which is again has been an increase with new supply to the market. Overall vacancy does not paint the whole picture though. With Wellington, the prime sector of the vacancy is sitting at about 6%, highlighting that flight to quality again, and the similar trends to what we're seeing in Australia. The barometer you're seeing on the current slide, we use across all of our sort of sectors, and it gives you a bit of an illustration as to where we see different aspects of the market, whether they're sitting in a tenant unfriendly, a balanced or a tenant friendly section across all the areas that we assess in terms of cost, risk, flexibility, the obligations and guarantees. So you'll see that happening everywhere. Lease norms are still largely drafted, leases, and the norms are still largely drafted from a landlord perspective. But we are seeing some shifts, and that's our constant objective, is to keep moving those shifts in favour of the tenant. And we'll touch on these as we go through today's presentation. The ongoing challenge for all tenants is not to accept the lease norms as being standard, and to push the boundaries and ask the questions, ask for what you're wanting, and pushing that focus on transferring risk and obligations and guarantees back onto the landlord. It's not an easy process, but it's one that's much easier in a tenant favourable market. And I suppose that's what we're generally, in our opinion, seeing across most of these markets now. It's we've got vacancy statistics that are favourable. It's compounded by the fact that you've got lower and shallow levels of depth and demand and alike in pretty much all of those markets. There's fewer tenants competing for the same space. It does change, within sectors. The higher quality buildings now are probably, those vacancies are tightening, and there is a bit more competition. But it means landlords are still well aware that these overall vacancy is going to remain reasonably high for some period of time, and therefore, with the right strategy, there's some good outcomes that can be negotiated. So if we look at those trends that we talked about, the flight to quality, that's been a pretty stable one in the marketplace for some time now. And it's resulting in a two-tiered market with significant vacancy now falling into the second point there, into those secondary markets. New supply being added in is keeps pumping up the premium and the A grade level, but it's still not getting to the vacancy levels like it is in those secondary areas. Tenants are carefully considering that value proposition in each of the alternatives. Many cases, high-end A-grade buildings now can compete with some of the premium grades. It's certainly the case in the smaller markets like Perth and probably Adelaide. And in some cases, they offer a better value proposition overall. But the secondary grade, if tenants can look into a second level of location, the B grade, a quality B grade, and many owners are spending money on refurbishment of those buildings to keep them competitive, particularly in non-CBD markets, then there's some really good opportunities in that space from a tenant perspective now. But there are examples in some markets, certainly in WA and Melbourne and many of the CBDs, where buildings have held vacancy for 18 months or longer. And that's meaning those owners are very motivated to do attractive deals. The reuse of existing fit outs is becoming common, both from a landlord speculative fit out market, where they're doing some brand new spec fit outs from a cold shell to warm shell type space. But wherever possible, they're looking at space going, how can we reuse some or all of the form? Is it a case of simply putting in new workstations? It's more cost effective, which allows more of the incentive to be retained as abatement. It makes it more attractive from the tenant side. And I've certainly had clients here in WA that are looking at buildings specifically with that in mind, is we don't want to spend all the money on a fit out. We really want to try and rebirth something. It works with them on the ESG side as well. But the big driver is that leaves a lot more money in the tank to then allocate towards rent abatement going forward. Fit out costs are still increasing. They've stabilised, and they're probably increasing at a much slower rate now. But when you've seen what was $1,000 a square metre fit out 12 or 18 months ago now being $1,500 to $1,800 a square metre, it makes a lot of sense to reuse what we can. Tenant demand remains subdued. For example, CBRE have released a report here in WA that 22% reduction in inquiry by square metre compared to this time last year, albeit the number of inquiries have increased. So it indicates there's probably more activity at the smaller size of the market than there is in that larger sort of tenant space. Given the current economic and geopolitical sort of uncertainty, we anticipate the trend to continue over the course of 2025. Many tenants are taking a wait and see approach. There's evidence in some markets where the local team on the ground may be promoting and negotiating for a relocation. And then when it's going up for final board approval, those approvals aren't forthcoming. The feedback back to the local team is no, stay where you are, take your incentive as abatement, go into cheaper accommodation and reduce those costs. So there's certainly a lot of uncertainty, and our experience, uncertainty tends to result in indecision across the market. When we start looking at lease renewal, as I've already said, landlords are under increasing pressure now to retain their existing tenants. So there's a great opportunity to leverage that from our client point of view. Building valuations are down, as Ed alluded to earlier. They're probably just starting to show their first signs of improvement now. But that improvement is really premised on levels of occupancy being maintained or improved and rental growth coming through. The rental growth that we are seeing across the markets is relatively modest and also being driven more as the differential between the economic rent to build a new building increasing, allowing the owners to push up a little bit on the face rents on the existing stock as that differential starts to increase. Incentives are comparable on a deal to stay put. So it's important to make sure if the building and the premises suits the business, work with your existing landlord, as well as going to market to talk to other landlords. You need to create that competitive tension. But if there's not a fundamental room to move, quite often, and we're seeing a lot of it now, the renewal alternative is financially a more attractive outcome. Flexibility in lease terms, again, in a tenant favourable market, this is where we can push harder on getting better flexibility for our clients, whether that's in the terms of early termination clauses, expansion rights, contraction rights, even options to renew that where many cases landlords weren't happy to offer options. We're now finding that a lot easier to achieve. ESG is still an important component of it. Reporting for businesses is becoming more, is the new norm. They're looking to partner with building owners that can help them through that process. Larger buildings are really leveraging what the landlord's doing in the building to help contribute towards them achieving their targets. So it's it is a considerable consideration when they're moving forward. Finally, going early, as I said a little bit earlier, lease expiry is not the only trigger, and we are constantly talking to our clients early, even halfway through a lease term. Let's do a health check. Look at where the rents sit in terms of the market rents. What have your competitors done? And very often there is an opportunity to sit down, certainly with the more institutional proactive landlords, where they are being pushed to maintain and the levels of occupancy, retain tenants, change their weighted average expiry profile. Talk to them early, and let's talk about a lease extension that gets you more favourable terms, whether it's lowering the rent, building in that flexibility we spoke of, and then increasing a bit of lease term at the back end to assist. Finally, in this table, we present the strategies that we're sort of talking to our clients about and the associated outcomes. And probably the three most relevant in the current marketplace now are that portfolio optimization and review. As I said, don't wait till the lease expiry. We've had situations, a good example, a law firm that we're working with that traditionally is reactive and only looks at these things at lease events. We did a review of the portfolio, and the business realised that many of the leases are not aligned with their business strategy. They were generally unfavourable. The business was able to reset their leases in Sydney and Brisbane and now in Melbourne, and moving to higher grade accommodation with a better fit out that's aligned to their business at a similar occupancy cost to what a renewal looked like. So that the counter side is the renewal opportunities become attractive and those owners become aggressive. The other landlords in the market have to be as aggressive or more to encourage the clients to do the relocation. Lease restructure before expiry. We've talked fairly substantially around that, but we've had one exactly that happen in Perth. We did a midterm review, highlighted an opportunity to renegotiate. They got significantly improved terms in return for a longer term commitment going forward. And finally, go big for substantial change and risk transfer. It's always important to start with the business objectives and strategy in mind, and ensure that the lease premises supports the business, not the other way around. Tenants quite often have preconceptions, and I know talking even with the lawyers, they have preconceived ideas of what's normal, what's typical. The reality is every clause in a lease is negotiable. If you have a sound strategy, leveraging position, don't be afraid to ask for substantial changes and movement. The worst that's going to happen is say no, but sometimes you'll be pleasantly surprised as to what comes back from an owner. Achieving things like performance criteria on services and services failure clauses used to be, and a lot of owners will still say, no, we're not agreeing to it. But there's an increasing number of them that are looking at going, the reality is it's not an unreasonable position to take.
Perfect. Thanks, Graham. Moving on now to the retail market snapshot. We'll look at the leasing trends, the large format overview, the shopping centre review, CBD, and then, of course, the tenant perspective. But just quickly touching on the trends, the Australian retail market continues to show mixed performance across the different segments. In the large format retail sector, vacancy rates have decreased due to limited new stock entering the market. This supply constraint has contributed to sustained demand for available space. In contrast, vacancy rates in other retail sectors remain relatively static, though notable disparities exist within the different submarkets. Strip retail, for instance, is experiencing higher vacancy rates in some locations, while shopping centres continue to maintain tight occupancy levels. These variations highlight the evolving nature of consumer behaviour and the shifting dynamics within the broader retail landscape. Despite softening retail spending, with households adjusting to cost of living pressures, we continue to observe upward pressure on effective rents. Across most retail markets, rents have increased while incentives have declined, reflecting continued demand for well-located retail spaces. One point of relief for retailers is the easing of the CPI-linked rent increases. After reaching peaks of 7% and 8% in 2023, CPI figures have now moderated to around 2 to 3% in most markets, providing more stability for tenants facing cost pressures. As the retail landscape evolves, navigating these shifting conditions will be crucial for both tenants, with location and asset quality playing a significant role in performance outcomes. Over to Adrian.
Thanks, Ed. So as Graham highlighted, the parameters within the office market, the lease norms for retail remain unfriendly due to the supply side power and market coverage that landlords hold as a collective over retail tenants, as well as restrictions within the Retail Leasing Acts. With market conditions, they're quite varied over the different types of retail. In theory, they should favour the tenant. However, landlords are not taking into consideration the needs of tenants in light of the current economic conditions, instead making sure that they as landlords are not worse off, irrespective of what the market conditions are at. With the retail market experiencing difficulty due to cost of living pressures and interest rates, landlords should look at ways they can assist their tenants and create long-term relationships, not hinder the tenant. Before we move on to the next slide, as Ed alluded to earlier, there's been so much coverage of Trump since he became president. And at every conference or presentation that we've attended over the last 3 months, there's always a question about what the Trump effect is and the effect of his tariffs. So I'll touch on that briefly. The one constant that we're seeing is that Trump continues to chop and change on tariff percentages with a lot of detail lacking. You might have seen in the press this week the tariffs on the film sector. So it's quite hard to gauge the overall effect at this stage, and we probably won't see a trend until Trump settles on tariff percentages for the long term. However, most market commentators believe that the introduction of tariffs will have a negative effect on the US economy and therefore the worldwide economy. So with large format retail, from a sales perspective, the March quarter retail trade figures showed that there was no growth in electronic goods, hardware and building supplies, and a slight fall in furniture and houseware retailing. The lack of new properties and space in large format retail is continuing to drive face rents with limited opportunities for new and relocation sites, and a lot of deals being negotiated off market. It is now rare to see rents below 300 per square metre net. Due to the slow retail trade, most retailers are therefore slower with their decision making, and those that have streamlined their processes for approvals are able to secure the limited sites that are on offer. Most landlords accepting of incentives on new sites, however, there is a reduction in capital available for fit-out works, especially from the smaller private landlords. Incentives on renewal are almost non-existent given the increased cost of borrowing money. Currently, most large format clients are investing in data, market research and benchmarking, as well as network plans to help inform them from a portfolio perspective on where to select the best locations, especially given the costs of fit-outs, to review any cannibalization from neighbouring locations, and how to maximise stores' sales productivity given the lack of new floor space available. With shopping centres, further to what I discussed in the LFR section, the ongoing challenge in retail is that March quarter retail trade figures show that there was no growth of retail spending compared to the last 3 months of 2024. This shows that the uptick in sales in the December quarter was predominantly shoppers seeking discounted goods in the sales periods, not from confidence on the back of improved economic conditions. However, clothing, footwear and personal accessory retailing did increase slightly in the March quarter, whilst department stores fell by 0.5%. As we move into the June quarter, shopfront conversion becomes more important than ever, and the hope of more interest rate cuts, which will result in more spending in the retail sector. Shopping centre landlords are still seeking rent increases on renewal by 5 to 20%, along with longer lease terms and fit-out upgrades. Many tenants in larger shopping centres continue to be affected by relocations on renewals as the landlords revisit tenancy mixes and seek international tenants and new brands to maximise turnover and rental growth. As with large format retail, the shopping centre sector is also feeling the effect of additional retailers going into administration, with alley fashion and winter shoes being two of them most recently. However, this is creating for opportunities, with one client we are currently representing moving from online retail to bricks and mortar by committing to a number of sites around the country on short-term reduced rent leases and taking advantage of reusing existing fit-outs. Go to the next slide. With the CBD, retail rents have remained stable over the past quarter due to the effect of interest rates, reduced discretionary spending and the work from home factor. Landlord in CBD buildings wanting to activate lobby areas are being forced to consider subsidising rents to attract cafe and food operators. In the suburban markets, negotiating outcomes for smaller retailers is challenging due to landlords not willing to accept changing market conditions if it does not favour them. Just this past month, we negotiated with a landlord who was unwilling to reduce the rents due to their costs increasing, even when the evidence showed the current passing rent to be 30% higher than market rents. To finalise an outcome, we had to pivot and instead negotiate a number of works to be undertaken by the landlord, as well as a slight reduction in rent. From a new site perspective, tenants continue to be considered in the decision-making with new sites. Given the investment required for a fit-out and the challenging economic conditions, tenants are only considering sites that tick all their boxes from a location, signage, and parking perspective. No longer will they consider secondary locations that they may have accepted pre-COVID, as they want to ensure that their business has the best opportunity to be successful. There are a number of strategies that a tenant can enact to receive favourable outcomes within the retail sector. We've highlighted two in orange that have relevance to what I've talked about. First being lease restructured before expiry. Commence discussions well before the expiry date, which provides the time required to successfully leverage the tenant's advantage, as time is the biggest lever for a tenant. Premises due diligence and negotiation. Use data, consider customer demographics, research rents, and benchmark against competitors to ensure that the entire portfolio performs and the sites are in the right locations.
Thanks,
Thank you.
Adrian. Thanks, Adrian. Just touching now on the industrial market, we'll have the overview, the current centres, the trends, and the tenant perspective. Just quickly kicking off with the overview, the Australian industrial market is undergoing a shift, with vacancy rates beginning to rise, offering some relief for tenants who have faced historically tight conditions. These moderate increases are creating more leasing opportunities and improving negotiating leverage for occupiers. As mentioned last quarter, New Zealand's vacancy rates now have also started to increase following the upward trend seen in Australia. The surge in demand driven by e-commerce appears to have tapered off, contributing to a more balanced market. Recent research indicates rising vacancies and plateauing rents. In Sydney, vacancy has climbed to 3% following record lows in 2023, with other East Coast markets also showing slight increases. Effective rents are now under downward pressure as tenant incentives have doubled in some regions over the past year, and face rents have declined by around 10% since the start of 2025. Moving on to you, Ken.
Well, thanks, Ed. As you guys are seeing, in terms of the barometer, it is actually slowly shifting in favour of the tenants. However, whilst the market is adjusting to lower demand and better levels of supply, there is actually still limited leverage for both tenants in the market conditions and lease norms. The needle is with the needle slowly shifting back to a tenant. There needs to be careful consideration in terms of the business needs, knowledge of the market, and experience. In terms of the market status, I think as Ed alluded to, there is pressure on the e-com business as a result of the rising cost of living that Trump, which previously fueled the warehouse demand. With this shift, it has led a rise in vacancy rates and a reduction in effective rents, which we haven't seen over the past few years. Look, despite this slowdown, there are still pockets of growth. I think this week in the AFR, it was reported that Amazon did open up their 20,000 square metre fulfilment centre in Western Australia, which demonstrates ongoing investment in key markets. Whilst demand for industrial space is actually moderating, this signals a market correction as the sector starts to stabilise. As Ed alluded to, we have seen a slight increase in vacancy rates across all states, across Australia and New Zealand, but Australia still continues to have one of the lowest vacancy rates globally. As the demand softens, sublease options are becoming more prevalent, creating additional pressure on direct leasing. Some landlords on the direct space are responding by reducing face rents, offering higher incentives, with incentives now ranging from 15 to 20%, which is a significant increase from incentives just over a year ago. In terms of market trends, it is notable that the industrial market is actually going through a change at the moment. Throughout 2025, we are expecting vacancy rates to gradually increase across this year. In line with this transition, the rents are softening in some markets, particularly in areas further west of the CBD markets, ranging from 5 to 10% as a decrease. However, we are seeing some institutional landlords striving to maintain face rents, which result in increasing incentives. In some cases, in the Sydney fringe market, some landlords are seeking rents as high as $500 per square metre for renewing tenants. With the rise in construction costs and a moderation in demand, developers are adopting a more cautious approach with prioritising projects with pre-commitment tenants before proceeding with new builds now. An example of this is one of Mirvac's executives highlighted the challenges posed by rising building costs due to a number of construction firms collapsing and increased material costs. After a period of sustained double-digit growth, we're now seeing a more stabilised market. However, rent levels remain high, driven by ongoing demand and limited supply. In terms of landlords, we are seeing landlords land banking with a focus on future data centre developments. This is evident in markets closer to the CBD. And this trend is driven by a strong demand for the urban logistics infrastructure and a rising cloud computing requirements. Further west, we're also observing a shift where landlords are actually redeveloping larger warehouses into small industrial units. This approach provides them with the leverage for rental uplift, whilst addressing the demand for flexible spaces. So on this slide, we'll look at some potential strategies that can assist in achieving a more balanced, tenant-friendlier solution. A couple of strategies that the guys have actually highlighted previously is lease restructure before expiry. An example of this is actually focusing on your costs, reviewing your rent just to understand where it sits with market, and whether there's an opportunity to actually reset that prior to your expiration date. Side deeds with variations. This can involve transferring some risks to the landlord or looking at the landlord's portfolios, in particular some sustainability commitments and negotiating some additional works, as Adrian had negotiated for a retail tenant.
Perfect. Thanks, Ken. Well, we've gone over time. We do have a question. So we'll quickly answer one question and then I think we'll wrap it up. So the question is, my workplace is responsible for offices across the state. These are primarily office spaces with some retail leases in non-CBD areas. Do we have any stats on these areas? I think we can provide those, can't we, afterwards?
Yeah, we might reach out to Cameron directly and have that conversation.
Not a problem. Well, thanks everyone, and thanks for staying overtime. Apologies we've gone over. We will see you all next quarter in August for when we'll look at the Q2 status. Thank you, everyone.